Hi, this is Courtney Carroll. Welcome to Mortgages with Courtney. So glad to get into today's topic. Today's topic is about, I've got bad credit. Can I still get financing for a mortgage? We're going to dive into that in the next little while. Three things I'm going to be sharing with you today. First and foremost is, what are the different categories when it comes to your credit score, and where do we fall based on our credit scores? Secondly, what are some of the misconceptions that people have right now when it comes to individuals with poor credit? I want to dispel some of those misconceptions because there's some reasons beyond individual controls at time that causes them to have a poor credit, and we want to fix that up and give some strategies for how individuals can right the ship if they've fallen on some hard financial times. And lastly, who do you listen to? Who do you listen to when it comes to your personal finance, when it comes to your relationships, when it comes to your career goals? Who you listen to has the ability to change the trajectory of your life. So make sure you're listening and taking advice from individuals who have competent information and credible information to share with you. I'm going to give you a story of a young lady that I ended up serving years ago and how we changed the trajectory of what she's done with her real estate career simply because she came to the right individuals at the right time to get accurate information. So those are the things I'm going to cover as we dive into this video. But first and foremost, let me go into why this channel was created. This channel was created as a way to provide answers to frequently asked questions by homeowners, individuals I've served in the past, and individuals who are currently contemplating getting into the mortgage game as far as homeowners, but yet are not sure about how the process works and all the various aspects of mortgage financing. So instead of me trying to go back and forth through email and answer things one-on-one, I decided to create this platform on YouTube to address some of those frequently asked questions and share it to the mass. If you find the information beneficial and relevant for your personal situation, please understand that keeping knowledge to yourself does not help. It's best to share that information with others so knowledge grows and people can make the best decisions when it comes to their own personal financing as it relates to mortgage and real estate. So those are the pieces I want to share with you. We're going to jump right into the content of today right now by first and foremost talking about, number one, what is a credit score? What are the 5 different categories of credit score, and how are they impacting each of us as consumers, and how we are viewed by lenders based on the categories that we occupy? So first and foremost, what is a credit score? A credit score is a rating system, and it's a rating system to really take a look at us, the consumers, and our credit worthiness when looked at by lenders. And so the credit rating ranges from 300, which is the lowest, to 900, which is the highest. So everyone is within those ranges, and where you fall along that continuum will determine to the lender how much they should trust you, what kind of interest rates you can qualify for, how big a loan that you can get from them, and so on. So there are 5 categories, as I said. So let's start off with the first category. I'm going to start from the lowest category, and we're going to work our way up to the highest category. First and foremost, when we talk about bad credit or extremely poor credit, we're talking about individuals that may have had some derogatories on their file. When we talk about derogatory simply means that they've either gone through a consumer proposal, they've either gone through bankruptcy, it could be a divorce that caused them to split assets, and they are now in a situation where their credit has taken a huge hit. So in this situation, this individual or these individuals find themselves in a classification, a category of bad credit. So the range of credit scores in this category will range from 300 to 599. So this is what we call bad credit. Individuals who have a bad credit score will find it extremely difficult, if not impossible, to get any kind of a lender to work on their file simply because of where they are positioned on that continuum. The next category above bad credit is what we call fair credit. And this is an individual who has a credit score of 600 to 649. Now, these individuals may not have, derogatories on their file, but they may have missed a couple of payments here or there, may have been late on a couple of credit payments. Maybe they've not established credit for a long enough time, and this has impacted the rating that they've been given. So this is considered to be, fair. 600 to 649 is what we consider to be fair. Good credit is what we say is about 650 up to about 719. And good credit really, consumers with good credit scores are looked on favorably by institutions. Most institutional players will say, this person is trustworthy enough. We're going to give them a loan. We're going to give them some preferential rates when it comes to a mortgage financing or a car loan or what have you. So these are individuals that are in that good range. Above that, we've got what's called excellent credit. And excellent credit is from 720 to about 799. And there's a lot of Canadians from, ranging from good to excellent. That's the majority of Canadians are above good to excellent. And that's a great range. If you're in the excellent range, pretty much Bob's your uncle. You can walk into any financial institution and you pretty much have, any kind of financing you want. You're seen as somebody that's trustworthy, that's very unlikely to be delinquent on payments or late on payments, that you will not renege on your responsibility. So lenders like this group of borrowers, and they will lend them money day in and day out. And then the final group is what we call those who have exceptional credit. Okay, this is, above average, above excellent. These are individuals that range from 800 to 900 credit score. And yes, I've worked with individuals finding mortgages with credit scores in the mid to high 800s. And so there are many Canadians, probably about 10% of Canadians have credit range in the 800 to 900 range. These individuals have always managed credit well, have managed their finances well, understand their responsibilities and obligations when it comes to the contracts they've signed that have given them access to credit, and know how to use it. And so they manage it in such an exceptional way that regardless of what it is they want, whether it's a business loan, whether it's a car loan, a mortgage, they will have the best rates possible, and they will have access to the most amount of money because the lenders know that their money is safe with these individuals. So those are the 5 different categories. Take a look at the simple diagram of the credit score and the band category that you fall into. Like I said, those 5 categories are explained. You can see it here on the diagram. So now that we have a better understanding of the 5 categories of credit, let's take a look at what happens when you have poor, very poor credit, ranging from 300 to 599, and how that limits your ability to take part in the real estate market in Canada. Now, it doesn't mean you can't take part. Individuals that have a credit score of 599, obviously they've had some delinquencies. As we said, as long as they've demonstrated that they've been able to reestablish credit for at least 24 months after a consumer proposal or a bankruptcy has been discharged, they can still take part in the real estate market. But they must demonstrate that they have managed to rebuild their credit, no delinquencies, no late payments, and that credit history can be tracked, and that they've got major credit cards or what we call financial institutions as their credit sources. If they're able to do that, then they can participate and purchase real estate. However, they will need to come out of pocket 20% down for the down payment. And so what does that mean? Let's assume that this individual wants to buy a $500,000 home. They will need to have $100,000 of the purchase price, which is 20%, in order to take part, which means they will only get a mortgage of 80% loan to value. This is really a difficult position for Canadians to find themselves in. Let's face it, the majority of Canadians are underprepared when it comes to having investments and savings for their future. So the average individual will have a difficult time having $600,000 or $100,000 put aside for a down payment. But that is what's going to be required for individuals who find themselves in a situation where their credit has been extremely poor, for delinquencies, bankruptcies, and so forth. That is the very bad credit score. Now, the next layer is what we call the fair. And this is really what I want to focus on for the rest of this conversation. Individuals in the fair credit profile, they have an opportunity to shift things around. They still have an opportunity to take part in, buying real estate with only 5% down. Having 5%, which is $25,000 for a $500,000 purchase, is a lot easier to come up with than having to find 100,000 like the individual with a credit score of 300 to 599. So we want to talk about that category because I believe that area and that consumer needs to understand that there are opportunities here for them. So before we do that though, let's talk about the factors that have led to individuals that may find themselves with a fair credit score rather than a good credit score and what they need to do to change that. When it comes to fair credit score, there are a number of life events that occurs. I'll give you an example of what happened to me when it comes to missing a payment. Several years ago, I took a trip and I was off in Asia for about 28 days. And normally when I get my credit card statements, I always have them on my table. I open all my envelopes automatically when I get them. I don't like to leave things in envelopes. I know exactly what comes to me, what's owed, the dates that they're owed, and I try to pay my bills in quick fashion and not leaving anything behind. The reason being, it's easy to forget things. And for those individuals, and some of you are listening to this and you can attest to this, if you have your bills and you leave them in your envelopes, it's easy to forget that they are there. And people forget. Life gets in the way. You've got family obligations, you've got kids, you've got work. If you put those things out of sight, out of mind, and before you know it, you've been late on a payment or you've missed a payment. Flip back to what happened to me. I'm on my trip in Asia, loving what I'm doing, away for 28 days. Bills came through, I had them on my table, forgot to pay them. So now I've gone through that grace period to pay my bills. I come back to Toronto only to find out that I'm being charged extra and that I've missed a payment. Fortunately, I had a great relationship with my credit card company and they were able to forgive that and wipe that clean and I was able to pay and get caught up. But the average person may not have that relationship, may not have seen that oversight, and that adds to their credit getting a hit. So if you're in the fair position, it could be because maybe you're not organized. Maybe you don't pay your stuff as soon as you get them. Maybe you're paying partials here or minimums here and leaving something for the next month. These things add up. Each time you miss a payment or late on a payment, you are getting hit, okay, when it comes to your credit worthiness. Another factor that we notice that leads individuals to have credit scores of fair 600 to 649 is that they're not accessing, sufficient lines of credit. By lines of credit, we're talking about having more than one credit sources. So it could be a credit card, it could be a department store card, and so forth. Lenders are looking for your credit history. And if there's no history or not a long enough history, it's hard for them to determine your credit worthiness. So what they're looking for is for you to have at least 24 months of continuous credit history, preferably with a number of different credit lenders. And it could be 2 credit cards, a Walmart card, it could be a Canadian Tire card, it could be a car loan. However, I would really advise you not to get a car loan until you get your mortgage. That's for a different conversation, but learn to buy assets before you buy liabilities. Taking out a big car loan is not a good way for you, especially if you're looking to get into the mortgage and home ownership, unless you've got the resources to do that. So those are some of the things that really impact individuals' credit score. Again, not having a long enough credit history, not having at least 2 credit lines open for 24 months, missing payments or being late on your payments, okay? Paying less than the minimum amount each month on the credit charges that you have. These all add to you moving away from the good credit score to what we call the fair credit score. If you can fix those pieces, then you can move your credit score up into the good area and have access to some of the top rates that are out there when it comes to mortgage financing. But part of the reason I put this video out is to give hope to those who may have fair credit score. There are a number of lenders here in the wonderful city of Toronto, in the province of Ontario, across Canada, who are willing to lend to individuals with fair scores. I've got lenders willing to lend and giving you the best rate possible, no premium added to your interest rate if your credit score is 601 or higher. That means they're looking at a GDS TDS ratio of 39.44, just like a AAA lender like Scotia, RBC, CIBC, and so forth. They're also willing to give you the best interest rate that is same as anyone who would have a 680 credit score. So there are ways to get into the mortgage business. And this is why I said at the start of this, who you listen to matters. There are individuals out there under the assumption that because they have credit scores that are maybe 605 or 610, they don't qualify for those lower interest rates and can't buy the same value of home as someone that can qualify with a 680 credit score. That's not the truth. The truth is, when you have accurate information, when you listen to credible people in the industry, the world can open up for you. If you want to learn more about how you can get into the real estate market with 5% down, even if your credit score is 600 to 649 and still have access to some of the best rates out there, then please direct message me, send me an email. Let's have a conversation started to learn more about your individual profile and how I can support you. It's so important that we understand and get accurate information about the industry. It's always changing. And so I'm very fortunate to be able to speak to BDMs, business development managers, on a regular basis to understand their product line and being able to bring that to you, the consumer. There are options out there for individuals with compromised credit. Credit in the area of fair, 600 to 649. Contrary to what some of you may have been told, you don't have to wait on the sideline to have your credit score 680 in order to take part in this wonderful real estate market we have here in Canada. The opportunity cost of sitting on the sidelines, either to increase your credit score to a point where you believe or were told that you needed to get it to, or to save 20% to get into the market, is huge. Let's say it takes you another 5 years to go from 5% to 20% down. That's 5 years of opportunity cost, of appreciation in the market and building wealth for your family. Conversely, it might take you a year or two to get your credit score from 601 to 680. If you're waiting simply to get to 680 before you participate, you've already canceled out 2 years of appreciation and pay down on your mortgage. So understanding information, knowing who to listen to, and getting solid advice is really important. If you're ready to take the next step, if you're looking to purchase your new home, your first home, if you're looking to refinance, downsize, please make sure you reach out via email. Certainly would love to serve you. Please share this information with as many people as possible, because it's important that we get information, accurate information, into the hands of those who could use it and who could benefit from it. Once again, this has been Courtney Carroll, Mortgages with Courtney. You can reach me at mortgageswithcourtney@gmail.com, or you can visit my website, mortgageswithcourtney.com. Those pieces will be in the information box following this video. So thank you again for being here, guys. We're looking forward to connecting on the next video. Stay safe, do well, listen to those who have accurate information. It can be the difference in opening up a world of opportunities for you. Courtney C. out.